What if one of the loudest tokens in 2025 is not on your approved list of blue chips? What if the real story is not only the price action, but the structure behind it? What if a protocol surging in attention forces us to ask harder questions about power, liquidity, and control in decentralized markets? That protocol is Aster. And after this breakdown, you will not look at trending tokens the same way again. In 2025, the macro picture is different. Bitcoin exchange-traded funds are live. Ethereum exchange-traded funds are live. Policy is shifting from tight to easing, with rate cuts reopening the risk window. Liquidity is returning to technology, to digital assets, and to alternative yield. But here's where it gets interesting. Unlike the last cycle, capital is searching for real yield, for hedging tools, and for blockchain infrastructure that institutions can actually use. Ethereum 2025 is not about cartoon profile pictures. It is about tokenized treasuries. It is about real-world assets moving on-chain. It is about institutional adoption that depends on predictable execution and robust governance, not slogans. Ethereum remains the benchmark. But as exchange-traded fund flows stabilize, the hunt for asymmetric upside moves to the edges of the map. This is where new protocols either earn a place in the stack or fade into noise. So what is Aster? Aster presents itself as a decentralized exchange for spot and perpetual derivatives, built to operate across multiple chains. The pitch is simple to understand and difficult to execute. Bring the sophistication of traditional derivatives markets on-chain. Allow traders to post capital efficiently. Offer tools that balance accessibility for newcomers with depth for professionals. On paper, the market is enormous. In practice, the burden of proof is heavy. The market may have missed one key detail. Aster's recent rise is not driven only by features. It is driven by controversy. Analysts have raised flags about significant token concentration in a small number of wallets. That raises questions about price discovery, market integrity, and sustainability during periods of stress. In a world where institutional adoption matters, these questions do not disappear. They compound. If you value deep research like this, subscribe to Crypto Wayfarer. We follow the money, not the noise. Let us locate Aster inside the 2025 landscape. On one axis, you have policy and liquidity. Central banks are easing. That brings flows back to growth, back to technology, and back to digital assets. On the other axis, you have structure. Exchange-traded funds for Bitcoin and for Ethereum have normalized access. With that normalization comes a different buyer. A buyer that needs hedging, needs risk management, and needs credible venues that can survive volatility. This is where derivatives infrastructure earns attention. This is also where scrutiny intensifies. Now here is the twist. In crypto, use frequently precedes legitimacy. Traders will test a venue because it exists, not because a committee blessed it. If the venue works, liquidity shows up. If it works through turbulence, liquidity deepens. And if incentives align with sustainable design, institutions keep watching. Ethereum 2025 sits at the center of this attention. Ethereum exchange-traded funds open the door. But the flow into the rest of the stack will favor credible blockchain infrastructure over empty promises. What is the bull case for Aster? First, the addressable market is real. Derivatives are the backbone of modern finance. If decentralized derivatives become a core layer of blockchain infrastructure, first movers with credible risk controls and genuine product demand can capture durable share. Second, the current rotation favors execution. As investors study exchange-traded fund flows and balance sheet health, they search for venues that translate liquidity into fee revenue, rather than purely incentive emissions. Third, the multi-chain strategy can be an advantage if it equates to distribution rather than fragmentation. Bridges to major ecosystems expand surface area for order flow. If the experience remains consistent, that surface area becomes a funnel. But here is where it gets interesting again. The bear case is equally clear. High token concentration creates fragility. During volatility, concentrated supply can amplify moves, distort incentives, and test trust. Regulators around the world are paying closer attention to derivatives than any other digital asset category. Scrutiny will rise, not fall. And while marketing can draw attention, only liquidity depth, robust risk engines, and transparent governance can hold it. If those elements lag, users migrate to larger venues on Ethereum Layer 2 networks or high-throughput chains that already host deep markets. The market may have missed one key detail. Controversy can generate volume in the short term, but durability comes from design. That means incentive alignment across traders, liquidity providers, and governance. It means clarity around treasury, unlocks, and emissions. It means that the path from curiosity to conviction is paved with data, not slogans. In 2025, with Ethereum exchange-traded funds reshaping the baseline and institutional adoption, moving from theory to practice, that standard is non-negotiable. Let us talk token mechanics in plain language. What does the token need to do to justify attention from serious money? It needs direct exposure to platform activity through fees or rewards that do not dilute long-term holders. It needs guardrails that discourage mercenary capital and encourage sticky liquidity. It needs governance that is more than a checkbox, with proposals that adjust margin, expand collateral responsibly, and manage risk during stress. It needs disclosures that make concentration risk visible and addressable. Without those, any rally is theater. With those, a rally can become a base. Now here is the twist. Aster is not the only protocol pursuing this lane. Perpetual exchanges are a competitive field. Some rivals have recognizable brands, deeper order books, or exchange integrations that plug directly into the largest pools of capital tied to Ethereum 2025. Aster's path to relevance is therefore not to be louder, but to be sharper. Sharper on risk. Sharper on collateral. Sharper on execution under load. Community and governance are worth watching. Healthy governance is the difference between a protocol that adapts and a protocol that dies quietly. Active proposals that refine risk parameters, adjust incentives, and expand collateral in line with market reality signal a living system. Stagnant forums signal a museum. In 2025, with institutional adoption in view, nobody funds museums. They fund infrastructure that ships. The market may have missed one key detail. Developer consistency is a leading indicator. Investors do not only track lines on a chart. They track lines of code. Cadence matters. Feature rollouts matter. Incident response matters. Silence is not neutral. Silence is negative. If Aster keeps shipping and keeps communicating with precision, trust compounds. If progress stalls, trust erodes. So where does this leave a grounded investor? Start with your framework. Ask whether the protocol is aligned with the forces shaping Ethereum 2025. Ask whether it benefits from the existence of Ethereum exchange-traded funds by offering the tools institutions actually use, like hedging and structured exposure. Ask whether the token design channels activity into durable value capture or into short-term theatrics. Ask whether the governance history shows a bias for shipping or a bias for showmanship. Ask whether blockchain infrastructure is the center of gravity for the next leg of adoption, and whether this protocol is part of that center or just orbiting it. Now here is the twist. You do not need certainty to act. You need clarity on scenarios. In the upside scenario, decentralized derivatives mature into a core layer of blockchain infrastructure, and first movers with credible design attract sticky liquidity, real fee revenue, and serious attention from treasuries and funds. In the downside scenario, token concentration and regulatory pressure cap adoption, liquidity migrates to larger venues, and the protocol becomes a footnote in the history of this cycle. Position sizing is how you respect both truths. Let us tie this to the broader map. Bitcoin exchange-traded funds pulled in a new class of buyers. Ethereum exchange-traded funds signal that institutions view the asset as infrastructure, not a passing story. That momentum is not a promise, but it is a tailwind. Protocols that extend Ethereum 2025 with credible tools for risk management, hedging, and structured access stand to benefit. Protocols that borrow those words but not the discipline will not. Institutional adoption will reward execution, not volume alone. The market may have missed one key detail. Real-world assets are not only a narrative, they are a bridge. As treasuries and cash equivalents move on-chain, balance sheets need hedges. That hedge demand does not live on social media. It lives in workflows. A derivatives venue that respects that reality will design for reliability first and marketing second. If Aster wants a place in that workflow, it must become boring in the best possible way. Predictable, transparent, tested, risks and realities in one place. Token concentration is a genuine concern and should be monitored over time. Liquidity depth must match growth claims. Regulatory posture needs to be forward-looking and conservative where it matters. If those three improve, the narrative changes. If they do not, the narrative ends. This is the difference between a speculative surge and a durable business. Bull case versus bear case, side by side. Bull case. Aster leverages macro tailwinds, integrates across major ecosystems, grows liquidity, and proves out a fee engine that rewards long-term participants. It becomes a credible part of the derivative stack that sits alongside the Ethereum 2025 center of gravity and benefits from institutional adoption. Bear case. Concentration persists, regulators tighten around derivatives, and larger venues capture the order flow when volatility returns. Aster's story becomes a lesson in how noise can look like growth. And this brings us to the grounded takeaway. Aster is not guaranteed to succeed. It is also not guaranteed to fail. It represents an asymmetric bet on a theme that is bigger than any one token. The theme is simple. Institutional adoption rewards real tools, real governance, and real transparency. If Aster meets that standard, it earns a seat. If it does not, it yields the seat to someone else. Either outcome teaches you something useful about how to allocate in this cycle. If you value deep research like this, subscribe to Crypto Wayfarer. We run toward the complicated questions so you do not have to. Stay sharp. Stay strategic. And keep wayfaring.